Good morning, friends. Welcome to this webinar titled Finesse, Add an Edge to Your Investing. Most investing tends to be always favoring one asset class at any point in time. Traditionally, Indian investing was always favoring the debt investor, and his primary vehicle of investment used to be term deposits. From there, we have seen a steady change in the behavior of investors, which has moved a lot of people towards multi-asset investing. But in the process, we have always tended to be biased in favor of one asset class. So, under different circumstances, one asset class has tended to dominate our preference. If you take in the 90s, it used to be debt. Traditionally, gold has always had its place to dominate the investment of certain sections of society. And if you take the recent few years, equity has gained that position of being the dominant asset class, something which people think is the only thing to invest in. But economic circumstances change, opportunities change, valuations change, and these changes only mean that we must review our preferences and open our minds to various options. Today, I believe, under the current circumstances, under the current economic conditions, debt is evolving into a very, very important opportunity. And that is what we are going to speak here in Finesse. 2023, a year that belongs to the savers. Why do I say this? We had biting inflation in 2022. That was primarily against savers. What did savers do to overcome inflation? They took on more risks. So they betted more on equity. Ask yourself a simple question. Did it really work for a majority of the people? Answer is no. So when inflation was going up, taking risk of a higher order in equity actually did not work. But 2023 could be very different from 2022. In the sense, inflation will peak out and probably start to slowly taper. Or at least it will stop rising. So the best and worst case scenarios is probably somewhere in between these two. But what we are going to see, despite the macroeconomic circumstances improving, is increased volatility. You are going to see a lot of volatility in asset prices, whether it's debt, gold, equity, commodity, everywhere you're going to see a lot of ups and downs, fluctuations. And that volatility will be the opportunity. How do you play this opportunity? Because things keep moving constantly. How do you actually make decisions? How do you plan your investing under these circumstances? What you need to practice under these circumstances is what we call as wait and watch investing. You have to keep your powder dry, always keep some money ready to be invested. And when opportunity presents itself, you need to choose to invest. That choice is yours. So simply waiting will not help, but a wait and watch approach will help. And whenever you spot opportunity, you must end your wait and invest some money. So as volatility keeps changing and as asset prices come in your favor, you make decisions in different asset classes. You buy some debt at some time, you buy some equity at some time, you buy other gold and other investments at different times. Last year, it was unfashionable to look at debt. So people did not invest much in debt. But this year, you can't be like that because the case for debt is growing and it could even get compelling in course of this year. But debt is not an asset class where you complete the whole process of investment and generation of return within 1 year. That is something you need to understand. Debt is like a very long duration crop. You sow in 1 year and reap later, maybe the next or the year after. So it's a very, very long duration crop. And this year is going to be a season to invest in debt. So you'll only keep investing in 2023, not taking out returns. That is something that you should be very clear in your mind. Also, you will see valuation and risk moving in the same direction when the circumstances turn in favor. That is something you need to prepare for. So, how do we generate outperformance in such an environment when everything goes in the same direction? I mentioned wait and watch investing. That's exactly what you do, and you invest when the opportunity presents itself. And you do that many times in course of this year. When you scale up your debt investments, when the valuations are in your favor, then when interest rates start going down, you will get outperformance. Outperformance is never going to come after interest rate moves down and then going to invest. You have to do it before. So probably towards the last 2 or 3 interest rate hikes, you need to scale up your investments, which is why this year is a very, very important year to invest in debt. You will get outperformance if you get the right opportunities and use them sensibly. So in that sense, savers who want to invest in debt, who want to have a portion of debt in their portfolio, will definitely find opportunities for outperformance in 2023. But 2023 is not just for savers who want to invest in debt. You will be spoiled for choice in 2023. Equity valuations will also come in favor. Gold will keep giving you opportunities to invest. Commodity investing will also see some select opportunities. So you're going to be spoiled for choice and where you should invest. But one thing is certain, the bias towards one asset class which we have seen in the last few years will go down. And I believe that people will use the choices sensibly when they are spoiled for choice. And that will happen in 2023. Let's go to the next slide. I mentioned that there will be a lot of volatility. So it will be a phase of uncertainty. The times will be difficult to navigate. And in times difficult to navigate, what happens when you choose to invest in safe investments? What happens when you allocate a part of your corpus towards safer investments? First, you will have a favorable risk reward during these times. Second, the stability of your portfolio will increase because suppose you're having one asset class and it doesn't do well, then your whole portfolio will not perform and give you anxious moments. Whereas when you have a mix and if debt is a conscious part of that mix, I believe that you will see debt performing well when equity is a laggard. You have seen equity performing well when debt was a laggard. Now, it's probably a phase where the trend could reverse. Also, many people may say, okay, I'd again go back to putting money in term deposits. Why can't I do that? The simple logic is when interest rates are high, if you invest in the right debt investments, you will make appreciation in addition to the interest. So your overall return will have two components. So when you find interest rates trending high, you must aim to get both component of return in your debt portfolio. You should not lock yourself into just fixed deposits, because fixed deposits will not give you any upside beyond the interest rate that you're going to get. There is no appreciation in that. Also, you will tend to earn more than what your bank pays, because in a fixed deposit, on whatever money you earn, whether you take the money out of the deposit or not, or whether the money is taken out of the bank or not, you will pay tax on notional income. Whereas when you make your investments in debt instruments, you will earn more post-tax return than your bank deposit. Also, when interest rates go down, that will add another layer of returns, because appreciation will be in your hands. So whatever debt investments you choose today should give you the twin impact of better rates and also appreciation. Debt investments also give you higher flexibility, because you can invest every month. You can invest lump sum as and when you find some more liquidity, and you can build your portfolio layer by layer. Also, when you construct a portfolio layer by layer, your risk management is superior. You don't take rash decisions. You break down big decisions into several smaller decisions which you can control better. For example, we may think that there could be only one interest hike in the year. I'm just saying this for an example. But there could be one more. When you build a layered portfolio, you will have a response to that second hike also. In fact, even if there are 3 hikes, you will still have a response. And you will be able to act on that opportunity. That is the advantage of constructing a layered portfolio. Somebody putting an FD will probably get locked in at the earliest interest rate and not get any advantage when the rates move up. Whereas somebody who does a layered portfolio construction approach will be able to build his portfolio layer by layer and create enough allocation to debt as an asset class within a reasonable time. What this would mean to the investor is that when interest rates start going down, they will make the twin returns of interest and appreciation. Also, the taxation will be far more efficient in this approach than it would be in the traditional deposit approach. Now I am going to make Samhita tell you more about how you can build a layered portfolio, what you need to know about debt investing, and how you can bring debt investing to become an integral part of your overall investment portfolio. Over to you, Samhita.
Thank you, sir. To begin with, we'll talk about what the common perception about fixed income investing is. Most people seem to think that it's very easy. All you have to do is buy one mutual fund or one deposit, look at the YTM, and then you can be very clear about what kind of returns that you get. But if we just look at how the market has been in the last 5 years, a lot of unprecedented things have happened to investors. So we had demonetization. Then there was a common perception that as long as you have a fixed deposit, it's fine. There's no way that you could lose money. But then PMC Bank went into a crisis and they didn't pay their deposit investors. DHFL also defaulted on its deposits. Then you had 81 bank bonds from both LVB as well as Yes Bank, which were written off. So for the first time, investors lost money in owning bank bonds. And now there's a lot more awareness about what kind of instrument 81 bonds are and the risks that are entailed in them. But at that point, it just looked like a higher return bank bond. We've also had a situation where a mutual fund had to wind down some of its schemes because of redemption pressures and credit risk within this category. And of course, we had the NBFC crisis also happen after IL&FS defaulted. So it has been a difficult market. Even the most diligent of investors have had to deal with some of these ripple effects that came from these events. And it's not really as easy as it looks, because there's more to fixed income than just recognizing what the return is and how long you're going to be invested in. So, to begin with, let's take a look at what the market outlook for 2023 is. So the first thing is that interest rates are high compared to how they've been over the last 3-4 years, especially because in the last couple of years, due to COVID, we've had very low interest rates. And on a global level, it looks like they are going to continue to rise. In India, inflation is moderating, but you're still seeing some persistent kind of risk where your core inflation is still high, which shows that while it's moving in the right direction, it could take longer than we expected to get to the target of 4%. When we look at liquidity, which is another driver in terms of what your market yields and your borrowing costs are going to be, we're moving towards a neutral situation from a surplus situation, which means you could possibly see higher returns as well as higher cost of borrowing if you're on the borrowing side. As far as the fiscal deficit is concerned, the government has done a good job and we're on track. In fact, states have actually borrowed less than expected. And we have the budget coming up in another week. So we'll actually know where we are or where we are headed in the coming year. Equity markets, as we've discussed, are likely to remain volatile because so many moving parts are influencing the direction of markets. And on a global level, we're seeing growth decelerating. So whether you look at the UK, Europe, or the US, you are seeing them battle with some growth concerns. But at the same time, since their inflation is also much higher, they have the twin challenge of managing lower growth and higher inflation through the same set of monetary policy tools. Like we mentioned, Indian markets are fairly valued, which means that when we were saying that you'll be spoiled for choice in 2023, that means you would have to look at decisions in both fixed income or debt and equity. And another place where you could get opportunity is that you have divergent global monetary policy, and this could influence flows as well as interest in domestic markets. So when it comes to returns, a lot of investors have this perception that your return is going to be your yield. So whether they are looking at a fixed deposit, whether they are looking at a mutual fund, the key thing that they study is what is the yield to maturity or what is the return that I'm going to get today. But are these two things actually the same? And time and again, over market cycles, we have seen that your returns are often not equal to your yield. And especially when those decisions are made based on the yield, it turns out that your return always turns to be less than the yield. So why does this happen? So if we look at the biggest sort of mutual fund category that garnered a lot of interest in 2022, it was something known as target maturity funds. The idea was that if you got into a target maturity fund, which says that this fund matures, say, in 2027, that would mean from 2022 to 2027, you had a 5-year investment horizon. And as long as your goal, right, was in 2027 and you made this investment and you stuck onto it, you would earn whatever the yield was on that day. But this doesn't happen. And let's take a look at how target maturity actually performed. So if we look at 2021 to 2020, end of 2022, so roughly let's say a year and a half. In this time frame, the return from a target maturity fund would have been around 1.5 to 2%. And that entire journey for an investor was very volatile. Why? Because you had interest rate hikes, you had a very active debt market in 2022, your yields fluctuated a lot. So your return will not be equal to your yield in this scenario. But can there actually be a time where you can study the yield and approximate a return that is equivalent to the yield? Yes. And this happens if you actually make your investment at the closer to the peak of an interest rate cycle, where you're locking in at a higher interest rate and you're layering the portfolio in the event of any surprises. So we actually looked at a target maturity fund, and we this was something that we advised our clients on in 2018. So when the NBFC crisis happened and you had your yields shoot up from 2018 to 2022, 2018 to 2020, the same time period of 1.5 years, the investor's journey looks like a smooth straight line, apart from the one event that you had in April 2020 related to COVID related stress in the debt market. So if you want a smooth journey and you want to do or follow a do nothing kind of investing where you're choosing a passive strategy, then what is going to make that work is both timing the market, that is getting in at a higher overall yield, as well as staying in the market, which is time in the market. So time in the market and timing the market is what is going to make passive investing work for you. The next priority for an investor would be to ask that, okay, if I am an aggressive investor, why should I even look at having fixed income in my portfolio? But what does fixed income allow you to do? It allows you to be at the right place at the right time. And this is because if you know that 2023 is going to be a volatile year in the equity markets, then you know that you will want to participate more this year, which means that it's the perfect time for you to book profits from your equity portfolio and then realize some of those notional returns and wait. Because we talked about wait and watch investing as well. So when the opportunity comes, only if you are in a in an instrument that allows you that flexibility to move from one asset class to another asset class without the risk of losing a notional amount, or without the uncertainty of what that amount is going to be that you can reinvest, you will not be able to make the best use of those opportunities. So even for an aggressive equity investor, this is a year where they should open their door and look at what fixed income has to offer to them, construct a layer that will help them grow their equity portfolio at a later time. So now an interesting quote on the power of liquidity. So yesterday the equity markets corrected 1.5%. For somebody who was already prepared, none of us anticipated this event happening. None of us anticipated how deep the market correction could be. But there were a lot of buying opportunities for a serious equity investor or a equity mutual fund investor. So what we need to learn from this situation is that we need to be very clear about where we want our money to flow when the market cracks. And you can only do this if you are already in an instrument that allows you that movement to move from one asset class to another asset class. So now we'll just go through some of the common misconceptions that investors have had when it comes to fixed income. So the first is that a lot of people believe that fixed income is only for a conservative investor because uh, the returns are much lower than what equity has to offer, and you can't afford to take too much risk because the risk is not as rewarding in fixed income as it is in equity. But what if you have a short-term goal? What if you like to go on vacation every year? What if you want some stability in your portfolio? In all of these cases, regardless of how aggressive you are as an investor, there is a case for you to look at debt as an investment opportunity. The other perception is that returns are always low, but this need not really be true. Selectively choosing what kind of risk you want is key to making good returns. And we ultimately need to look at risk adjusted returns or your ability to capitalize on other opportunities based on making a temporary movement into a fixed income. So another thing that we've noticed with, say, somebody who's looking at passive income, like a retiree, sometimes they think that, I have a sizable equity portfolio, dividends are enough for me because I can estimate a dividend return. But we know that dividends are not guaranteed, they are not regular. There is going to be some fluctuation in that income. Why would you want to take that kind of risk at a time when you don't need to take that risk. So having some structure, whether it is in terms of interest income through fixed deposits or bonds, or if it's in terms of following a systematic withdrawal plan so that your monthly income is guaranteed, that is key in any retirement plan. Then when we come to the reason why people think fixed income is investing is easy is because they assume that whatever you invest, at least that you'll get back. If not, your interest over and above that. But we know that in a bankruptcy scenario, your return of capital is prioritized. It's not guaranteed. So if we look at, say, Yes Bank, right? The 81 bonds were classified as bonds. The shareholders got the shareholders still had some value in the stock, even though it fell quite a bit. But ultimately, the 81 bond holders did not get paid on time, and this is something that we need to keep in mind. So knowing what you're investing in, what the risks are, where you stand in that pecking order in case things go wrong, that is very important for every investor. So being aware of these things is key. And other misconceptions include thinking that as long as you know the credit rating of a company, that is a good enough indicator to tell you whether this is a good investment or not. But we have seen, so ILNFS was rated AAA, DHFL was rated AAA, and these are entities with the best possible rating in the market, and they have defaulted in the past, right? So we need to go beyond that credit rating. It is a good indicator. There are certain things you can derive from the rating, but you need to go beyond that and understand how the entity manages its money, how strong its balance sheet is, how this investment actually is structured, meaning what protections do you get as an investor or in that particular bond. So another thing that people assume is that because fixed income investments offer a fixed return, that is, if you go to a bank today and you ask for a deposit, they're probably going to give you 7.2 or 7.5%, right? So you think that your returns are consistent, meaning this is what you're going to get at any time that you go to the bank. But actually, your returns in fixed income, much like equity, are cyclical because we need to follow the interest rate cycle. We need to understand where we are in that cycle and whether the potential to earn returns in fixed income is high or not. So if we looked at 2021, your potential to earn returns in fixed income was low. 2022 was more or less the same case, but 2023 we are seeing a reversal in this direction where your potential to earn returns has improved drastically. So coming to the ithought framework on where we stand. So within fixed income, you have many different strategies that you could look at. So we are positive on short and medium term funds. We like fixed deposits. We like bonds selectively. When it comes to credit risk, we are neutral. There are certain things that are in favor. There are certain things that we would like to wait and watch. So again, with credit, it goes without saying that not all credit is the same. You have to be careful in your selection. So similarly with alternate investment funds also mainly follow a credit strategy. So again, there you'd have to be a little bit more choosy. And with the long-term bonds, the key thing is to lock in at the right rate and at the right point in the cycle. As of now, we are not very positive on duration strategies. There could be some risk in how this goes. We also have a budget event happening next week. So that is something we need to be a little bit more cognizant of. So as an investor, if you are looking at fixed income, let's study what you would need to ask or how you would need to come up with a solution for yourself, right? So here are some questions that we need to reflect upon before we make a decision on what to buy or where to invest. So the first thing is to be clear of your investment horizon. So how long until you need this money? Are you looking at just a buy and hold kind of situation, or do you have a clear exit deadline? Meaning, is there a goal that you're mapping this particular investment to? The second question is, do you want regular income? So if you're looking at income, the instruments that you would study are very different from those that you would want if you're looking solely at capital appreciation. Then are you particular that you want fixed returns? That is, are you the kind of investor who would like to know today that if I'm getting into something, this is the exact return that I'm going to earn? Or are you the kind of investor who won't mind some variation in your return? The next question is about tax efficiency. So depending on your tax rate, so interest income is taxed at your marginal rate. So if you're in the highest tax bracket, you would be paying somewhere between 30 to 40%. If you feel that this is too much, uh, or this is eating into your potential return too much, and you would prefer something that is more tax efficient, then you would need to look at other instruments, right? Or you would need to lengthen your investment horizon. Then we ask about what level of comfort do you have in taking credit risk, right? Would it be okay for you to expose yourself to some names which don't have the same quality as what you would be comfortable with to earn a slightly higher return? And again, buy and hold, or are you looking at this as a temporary solution so that you can move back into equity or another asset class? Or are you looking at this as goal-based or short-term? So this is basically, these are the questions that an investor needs to ask to know what kind of instruments would suit them. So moving on to your choices, right? So if you're in a short-term investment horizon, you could look at corporate deposits. Your return would be somewhere between 7 to 7.5%, but your tax would be based on your slab rate. If you have a more flexible investment horizon, then you could look at debt funds. Within debt mutual funds, you have many categories that can be more closely aligned to, again, your investment horizon. So if you want to park money for 3 months, there's a separate category. If you want to park money for 3 years, there's a separate category. If you're looking at a much longer horizon, say 5 to 10 years, you have different opportunities in debt funds. So currently, your yields are somewhere between 6.75 to 7.75. And if your investment horizon is below 3 years, again, you would pay the same slab rate on your taxes. And if it's more than 3 years, you have indexation benefit and your tax rate is 20%. For market linked debentures, your investment horizon is more than a year, but typically between 1 to 3 years. Your yields are slightly higher on this instrument as well. So you would earn somewhere between 8.25 to 9.5%. And the taxation, there is an arbitrage here where your taxation beyond 1 year is 10% on your capital gains. With alternate investment funds, uh, typically the investment horizon would be 3 to 4 years or longer. Each scheme would have its own requirements. Uh, and your return expectation also would be above 9%. And your taxation varies depending on the structure of the scheme. But typically, your tax rate would be below your slab rate, closer to 20%, but there won't be any indexation benefit in the AIF. And then if you're looking at equity funds, like I think today having a horizon beyond 4 years would make sense, where you're looking at a 10 to 12% CAGR. And your taxation here is for less than 1 year for short term, that would be 15% on your capital gain. And for a long term investment, it would be 10%. So just a quick calculation to run you through indexation and how it works. So where you make your investment actually makes a big difference, because let's assume you invested 10 lakhs at 7.25% for 3.5 years, right? So if you went through a debt fund, your value at maturity would be close to 12.7 lakhs. Whereas if you had gone through a fixed deposit, you would have only earned about 11.8 lakhs. And this is primarily because of something known as indexation. So what is indexation? Indexation, firstly, is adjusting your cost of investment to inflation. And 2022, like Shamsa mentioned, was a year of high inflation, which means your cost is already going to be inflated a decent amount. So when you inflate your cost, then your tax base increases. So the amount on which you get taxed will reduce because your starting value increases. And accordingly, because you're also operating at a lower tax rate of 20% as opposed to 30%, there would be a double advantage of having an indexation benefit. So for this investor who does 3.5 years in the debt fund, their net of tax return is almost 7%. Whereas for a fixed deposit investor at the same 7.25% that they start with, they end up with only 5% as their return. So that difference is actually quite vast, and it almost amounts to 2% in the long run. So your decision on the product needs to be based on what your income tax situation is, what your investment horizon is. So now moving on to how you can navigate fixed income markets with finesse. This is just a little bit about our track record and how we've worked with investors over the past few years. So we have many quality filters that we apply when we're looking at products, which has helped us avoid some of the biggest defaults in the markets over the last few years. So we've had no exposure to ILNFS bonds, we've had no exposure to DHFL bonds, no Z Entertainment Limited, no perpetuals in LVB. We did not recommend any schemes with Franklin Mutual Fund. We did not have any bonds in SRE infrastructure, which again, so these are all situations where there have been defaults or there have been some issues for investors. So just an overview of how we've worked over the past decade is that in 2013, we thought it was attractive to look at government bonds and tax-free bonds because we were getting very good yields on them. Over a period of a year, we managed to exit gilt and move to medium-term funds. Then in 2015, we came back to looking at tax-free bonds because the yields were quite attractive. Then in 2016, we moved towards corporate debt or non-convertible debentures, where we were getting yields at 11 to 11.5%. Then 2017 was not a very attractive year for debt as such, so we didn't actively manage anything apart from goal-mapped investments. And then in 2018, we were able to look at a lot of attractive investment opportunities. We looked at fixed maturity plans. We looked at roll down, like I had mentioned, which is your target maturity. And we stuck to quality throughout 2018. In 2019, we started moving towards more open-ended funds, corporate deposits, as well as gilt. Then in 2020, we exited credit risk. We entered credit risk. We looked at longer term bonds. We looked at tax-free bonds. We started looking at floaters because we moved to a very low interest rate regime. And we looked at short-term deposits because we knew that possibly the interest rate cycle had to turn around in the next couple of years and we wouldn't want to be locked in at the wrong time. And we exited gilt funds. And over the last couple of years, 2021, our primary focus was floater. And 2022, we were looking at short-term funds and corporate deposits as well as bonds. And I think there's a lot to come in 2023 for us. And before we close, I would like to open out to any questions from the participants. So for an early investor in your long-term core portfolio, if you're an early investor and you're in the beginning stages, then we need to go by your risk profile. So if you're a conservative investor, then the allocation to debt should be much higher. But if you're willing to be more aggressive, you can probably keep it around 10-20%. And then when you're comfortable moving into the fully into equity also, you would be able to do that. Can you explain about where to look for MLDs? Yeah, so any bond dealer should have access to market-linked debentures, and there would be someone from ithought MFD can get in touch with you about what exact offerings are available now. Where do we park emergency funds and short-term funds in the current environment? So right now, I think if you're looking at emergency, we always would say keep it in a money market or a low duration scheme because that should be easily accessible. You can never predict when you will need that. So there's no need to take any credit or duration risk on your emergency fund. What should be the investment strategy for debt? Is it SIP or lump sum, which is better for wealth building? So we actually do both. The layering of the portfolio is for investors who want to do lump sums because then each lump sum we will layer at the right yield. If you want to do an SIP, then we would look at a different product, and that layering also helps because the SIP itself does an automatic layering through a monthly or whatever the frequency of your SIP is through that investment. If I am under 10% tax slab, which would be better according to current interest rates. So if you're under 10% tax, then it actually you're a lucky person because either the fixed deposit or the debt mutual fund would give you a good post-tax return. But currently, if you see the yield on a debt fund is slightly higher than the yield on your deposits. So if I was looking at a debt fund for 3 years, I might be getting a better return on that as opposed to a fixed deposit. What is the correct time to buy bonds when interest rate is high or low? So actually the bond market in India is quite illiquid, which means that your whatever your strategy in buying bonds should be with a hold to maturity mindset. So if you have a goal in 5 years, then you buy a 5-year bond. If you're willing to hold on to 10 years, then you buy a 10-year bond. But essentially the trading, it would be better to buy a bond when interest rates are high because then when the interest rate falls, you will get some capital appreciation. But given that the market is illiquid, we don't know whether you will actually, how easy it would be to liquidate that position and at what price it will happen. Does the team advise RBI and state government guaranteed bonds? Yes, there is no risk in that. As long as you're clear of mapping your investment horizon with uh, the bond that you're buying, I think that's a great investment opportunity. In M2W, will this year any debt MFs be added? Yeah, I think on the program, we will definitely keep you on the loop of whatever debt mutual fund opportunities arise so that you can also participate in this. Would it be a good time to lock money in a 20 plus duration fund of mutual funds, assuming the minimum investment horizon is 3 years for tax efficiency? So if you're going to look at a very long duration, that is beyond 5 years, that portfolio will be very volatile. And if you are aligning it to, say, your retirement or some long-term goal, as long as you stick with that investment or you're comfortable or you know that you can handle the volatility that is there, you can go ahead with it because you will get tax efficiency and you will be able to hold it. But in our experience, what tends to happen is if you have too much volatility in 1 or 2 years, then investors are not comfortable staying in that product with such a long investment horizon. Is it good to invest in international markets like US and Japan through mutual funds? On the equity side, there may be select opportunities, but this is a tough year in global growth. But on the debt side, I think India is a much better market in terms of risk reward. So it may not make sense to look at at an investment where the yield is lower and there is also currency risk for you. Any advantage for NRI with deposits versus debt funds for short term? No, sir. I think for NRIs, the most tax efficient option is the FCNR deposit or your where you don't have to pay any tax. Where I have to park my money for liquidity purposes. Any liquid fund, or if you're looking at something short term, meaning if this is to move into another asset class or investment opportunity, you can look at low duration, short term, money market, liquid. These are all good categories. Emergency funds we keep in short term fixed deposit is a correct option. Either a fixed deposit or a debt fund would work. The advantage of having a fixed deposit is the return is known and every year you'll have to renew it. The disadvantage is that if you take money out due to an emergency, you might have to pay a penalty or lose some interest in that. With debt funds, you can always look at an option where there is no exit load so that you don't have to pay any penalty. And the return also is not fixed. So that is something if you're comfortable with, you will have to look at what works better for you and make that decision. As 2023 might be volatile, so we might get the opportunity to invest in equity. Would it be wise to lock money in debt? So don't lock money, keep it in an open-ended fund, which you can take out of anytime, where there won't be much volatility. Because if you lock in and you're a serious equity investor, you don't want to miss out on that opportunity also. Funds, I think if you talk to our team, they will be happy to suggest fund names for you and assist you with the investment process as well. Yes, we can help with portfolio restructure. So if you talk to our team, we can do a one-on-one session where we look at the portfolio and suggest what can be done. What would be an evergreen debt fund? Would credit risk fund with lower risk be considered as a go-to fund across all cycles instead of moving across different types of bond funds? Or should one consider all seasons bond fund? So I don't think there is something such as an evergreen debt fund, because the market itself is quite dynamic. And within a debt fund, like we are holding a portfolio of bonds, right? Which means that today the portfolio of the bonds could be very different from what it is 3 years down the line. And you'll have to continuously evaluate this and see whether the quality is the same. If the fund manager changes, then the style of managing that particular fund could change. So there are many additional risks that are involved which would prevent you from buying and holding any fund with a forever kind of mindset. The closest would probably be when it's right to look at target maturity. If you find a target maturity fund with a specific maturity date, that might work. But even in that case, suppose you take a 10-year target maturity fund and you're mid-cycle, then when you're at the bottom of the cycle, you would have to look at exiting, right? So there is no option where you just buy one thing and stay with it. I'm not familiar, our previous session recordings available? If that is the case, then I think this would also be available. If it's not, then whatever the standard practice is.
On request, we may provide.
Okay. Does the team help to find bonds in primary issue or secondary market? Mostly it is secondary market. In the event that there is an interesting primary issue which suits an investor's need, we may be able to help them participate in that as well. So again, for your SIP requirements, this would be based on your risk profile and your goal or your expected return expectation. Probably we can do a cyclical adjustment, meaning when debt and equity are attractive, we will have allocation to both. When only one of them is attractive, we will switch the SIP into one of those asset classes. I can share our contact details after this, and we'll be able to get in touch with you.
Yeah, the next question is NRIs can invest liquid funds via today's. You can invest, certainly. You can invest in liquid funds. As it was told at the beginning, the next one.
Yeah, as it was told at the beginning, 2023 may see a slight rise or stable interest peaking the cycle. If not lump sum, can we build position towards the peak through SIP? Yes, we can. Whether ithought provides us this framework as a single debt fund or a combination of some bonds and debt funds. It will be a combination based on your requirements and what is the minimum required for, say, investing in a bond. If I have a goal that is within 10 to 12 months, where should we keep such money? Yeah, if your horizon is less than 1 year, you should look at funds which invest in securities less than 1 year, right? So that could be liquid, ultra short, low duration, or money market schemes. Beyond this, it would not be recommended because it's not matching your horizon. There is no Franklin fund schemes. So Franklin India Blue Chip is a equity fund that is different from the problem that Franklin had with the debt funds. Franklin India Blue Chip is a very good fund. You can continue to do your SIP. There is no problem in this. The issue that happened with Franklin also happened a couple of years ago in 2020. So it is not something recent. I mean, it is not something current.
And it's also resolved. The issue in Franklin is resolved.
Age limit of 25 to 40 years, person staying in fixed income strategy or equity side, which is best? Again, this is something that you would have to consider based on your goals as well as your risk profile. So for a more conservative investor, even if you're 25 years old, some exposure to debt might give you comfort and confidence in being invested in the market all the time, which is the outcome is a good thing for that investor. If you are more aggressive and you are comfortable taking higher volatility in the portfolio, you can lower the amount of debt that is there, or in certain cases, it might be advisable to not have also. What about your view on long duration fund debt current scenario? So there is risk because we know, I mean, we have one event happening next week, which is the budget. We also, the week after that, we have a monetary policy review. We know that inflation as a problem has not fully been solved. So there are certain risks that could affect duration, which we need to be careful and mindful of. So if an investor is comfortable and understands the risks that are involved, and they can weather the volatility, then yes, long duration, that is a call that you need to take in alignment with your goal. If there are other concerns, then it is better to wait and see what is the best way to play this.
One more. Yeah, there will be an equity investment program for small investors. In fact, M2W itself focuses a lot on equity, and there will be equity webinars also in due course. There will be regular webinars. Whenever we feel a topic is relevant and important, we will come to you with a webinar. Please attend. Please bring your friends also into the M2W, so that when you have more of you doing the same thing, you will be able to relate to each other and do a lot of things which will give you more confidence and which will also take you forward in what you want to achieve in your savings and investing. Will you help us procure stock equity? No, we are not in the business of giving stock advisory. We feel that most of the stock investing is happening very randomly. We want a more disciplined and a more methodical approach in investing, which I believe for a small investor is best done through mutual funds and ETFs. Now, there are so many books you can read. The Psychology of Money, which is one of the more recent books for every one of you to read. I think it's a very good book. You can read The Psychology of Money by Morgan Housel. It's a simple book and all of you can read that. Yeah, LVB Tier 2 written off. That is right. Can you believe private company debt was safe in India after LVB? See, write-offs will keep happening. Why did people go and buy this? That is the question. It was mainly because it was giving higher return. I'll give you an instance. I actually told a friend to sell it. He refused to sell it. And he had not bought it through us. He had bought it on his own. People assume that a bank cannot go bankrupt. That is not the way to look at it. When the facts change, you must change your investment opinion. Even when you're invested in something which you thought at one time was good. So I think most people are very static. They don't listen to the opinions until it is too late. That is the problem in this. In any debt investment, you have to monitor the investment. You have to read the credit rating reports. You have to read what is happening. If you don't monitor, you will lose money. Debt is a more sophisticated investment and you need to spend time to monitor it. Or you must have somebody monitoring it professionally like an advisor. Debt fund will be added to the M2W portfolio. That's absolutely right. You can add little money specifically for debt. Or if you have liquidity, you can say that liquidity can be used for debt instead of equity. According to your wish, we would apportion. But we will not simply sell an equity investment just to buy debt. The two decisions are separate. You can't connect those two decisions. Yeah. So that is broadly what we wanted to discuss with you. I'd like to thank all of you for coming on a Saturday morning and spending this time. It was really a pleasure talking to you on debt investing. It is very important for people to understand what they can get out of debt investing. Equity investing for people may give them, let's say, between 10 and 12% for a conservative investor. An aggressive investor may make another 1 or 2% in the long run. Debt investing is something which gives you a lower return, somewhere between, let us say, 6 and 8% as it looks now. And if people are able to use this current rising rate scenario to invest adequately into the right products, then there is scope to improve your returns going forward. So the next 1.5 years are meant to be used for investing into debt. And whenever the interest rates become adverse and when they rise and when exchange rate is also under pressure, that is a time to invest in debt so that when things stabilize, you will make better returns. Thank you very much for being on this webinar. And I really want all of you to continue actively on the M2W journey towards your milestones. Use debt also as an effective investment choice to help you reach your milestones sooner, because you will be able to travel in a much more safer way by investing some part of your money in debt as well. Thank you very much. Thank you, Sam, for joining me on this webinar.
Thank you, sir.